There is a setting in most Canadian brokerage accounts that most investors never turn on. It takes approximately 30 seconds to enable. It requires no ongoing attention, no research, no decisions, no market timing. You enable it once, and then you do not have to think about it again. And over 25 years, the difference between a $10,000 dividend portfolio with this setting enabled and the same $10,000 portfolio with it left off, no additional contributions in either scenario, same starting investment, same stocks, is approximately $35,000. $35,000 from one setting in 30 seconds. It is called DRIP, Dividend Reinvestment Plan. And the reason most Canadian investors have never turned it on is genuinely simple. It sounds boring. Reinvest dividends automatically. Great. Moving on. And that reaction, which is completely understandable, is also the reason most investors are leaving one of the most powerful compounding mechanisms available to them completely untouched. This video explains exactly how DRIP works, the two different types available to Canadian investors, the specific math behind the $69,000 gap, the one additional advantage beyond compounding that almost nobody talks about, when you should turn it off, and the Canadian tax consideration that makes your TFSA the optimal DRIP vehicle by a significant margin. DRIP is simple in mechanism and powerful in result. Here is exactly how it works, step by step. When a company pays a quarterly dividend, the cash normally deposits into your brokerage account, sitting there as uninvested cash until you decide what to do with it. With DRIP enabled, the brokerage automatically uses that incoming dividend cash to purchase additional shares of the same company, typically at no brokerage commission the moment the dividend clears. Those additional shares, purchased with the dividend, generate their own dividends in the next payment cycle. Those dividends also get reinvested. More shares, more dividends, more reinvestment. The loop runs indefinitely, without requiring any action from you after the initial setup. The three-layer compounding loop DRIP creates: Layer 1, dividends from original shares, reinvested. Your original 100 shares generate a quarterly dividend. Rather than sitting as cash, that dividend buys additional shares. Your new total is 100.3 shares, approximately. Next quarter, all 100.3 shares generate dividends. Layer 2, dividends from DRIP purchased shares, also reinvested. The 0.3 shares purchased with last quarter's DRIP generate their own dividend this quarter. That dividend also gets reinvested. The reinvestment is compounding on itself. Each cycle's new shares generating more income than the prior cycles. Layer 3, annual dividend growth applied to the entire growing share count. As the company raises its dividend each year, the per-share payment on every share you own, including all DRIP purchased shares, increases. The growing share count is earning a growing per-share dividend. Both the numerator and the denominator of the compounding equation are increasing simultaneously. A single $1,000 dividend payment, illustrated, without DRIP, $1,000 sits in your cash balance, earning whatever your brokerage's cash sweep rate pays, often close to zero. With DRIP, $1,000 purchases approximately 10 to 20 additional shares depending on price. Those shares generate dividends in Q3 and Q4 of the same year. Those dividends get reinvested into more shares. Over 20 years, that single reinvested $1,000 payment grows to approximately $3,900 in portfolio value at 7% annual total return, nearly 4 times its original amount from a single reinvestment rather than a cash balance. Why this compounds dramatically over time? The effect of DRIP is small in year 1, a few dozen dollars of additional shares from a modest dividend. It is transformative by year 20 and year 25 because every year's DRIP purchases have been generating their own dividends and being reinvested in turn. The compounding is not linear. It accelerates. Here is the vault. The two different types of DRIP available to Canadian investors, and the one additional advantage that most explanations of DRIP never cover. Type 1. Synthetic DRIP, brokerage level. The most commonly available type in Canada. After a dividend clears, your brokerage uses the cash to purchase whole shares of the same company at the current market price, typically at no commission. Available at most major Canadian discount brokerages, including Questrade, Wealthsimple, and the big bank brokerage platforms. The key limitation of synthetic DRIP: it can only purchase whole shares. If your quarterly dividend from a $50 stock is $47, enough to buy 0.94 shares, synthetic DRIP purchases 0 additional shares, no partial shares, and leaves the $47 in cash until the next cycle. This partial share limitation means the smallest dividend payments may not be fully reinvested in each cycle, reducing, but not eliminating, the compounding benefit. Type 2. Corporate DRIP, direct with the transfer agent. Many Canadian public companies, including most of the major Canadian dividend aristocrats, offer their own DRIP programs, administered directly through the company's transfer agent, usually Computershare or AST Trust Company. Corporate DRIP has two significant advantages over synthetic DRIP. First, fractional shares. Corporate DRIP programs typically purchase shares to 3 decimal places, meaning every single dollar of dividend income is reinvested, with no cash left over regardless of the share price. The full dividend is deployed in every cycle. Second, the price discount. Here is the additional advantage most investors never hear about. Some Canadian corporate DRIP programs offer shares at a 2% to 5% discount to market price. This means that in addition to the compounding benefit, participants purchase shares at below the price any other investor can access on the same day. Over decades, buying at a 3% discount to market price every quarter compounds into a meaningful additional return above what synthetic DRIP or cash dividend management produces. How to access corporate DRIP? Contact the company's investor relations team or transfer agent directly. Most large Canadian companies provide corporate DRIP enrollment forms through their investor relations pages. Note that corporate DRIP typically requires shares to be held in your own name, DRS, Direct Registration System, rather than through a broker's nominee name, which involves an additional registration step but is straightforward to complete. Which type should you use? For most Canadian investors, synthetic DRIP through a discount brokerage is simpler to access and provides the vast majority of the compounding benefit with no additional administrative steps. Corporate DRIP is worth considering specifically for positions where you intend to hold for very long periods, 10+ years, and where the issuing company offers a price discount. At that point, the discount, compounded over a decade, adds meaningfully to total return. Assumptions: $10,000 starting investment, 4% starting dividend yield, $400 per year equals $100 per quarter, 6% annual dividend growth, 3% annual capital appreciation, conservative, 7% total annual return. DRIP off, dividends taken as cash. The dividend arrives as cash each quarter. The portfolio grows only through capital appreciation on the original shares. The cash dividends accumulate separately and are not reinvested. DRIP on. Dividends reinvested. Each quarterly dividend purchases additional shares. Those shares generate their own dividends. The growing share count earns an increasing dividend as the company raises its payment annually. DRIP is not always the right call. Here are the specific situations where you should turn it off, and the tax consideration that makes your TFSA the optimal vehicle. When to turn DRIP off. Situation 1. You are in retirement and need the income. The entire point of building a dividend portfolio through accumulation is eventually living off the income. When you reach the stage where you need $1,000 or $2,000 per month in dividend income to fund your lifestyle, you turn DRIP off and let the cash accumulate in your account. The portfolio does not need to keep growing. It needs to pay you. DRIP is an accumulation tool. The moment you need the income, it becomes a liability rather than an advantage. When to turn DRIP off. Situation 2. One position has grown too large. If a stock you own has appreciated significantly and now represents 20% or 25% of your portfolio, above your intended maximum per holding, continuing to drip into it every quarter compounds the concentration problem. In this situation, you turn DRIP off on that specific position and redirect the dividend income to purchasing underweight positions instead. DRIP should serve your portfolio structure, not work against it. When to turn DRIP off. Situation 3. You believe the stock is significantly overvalued. If you have a specific, well-reasoned view that a stock is materially overvalued at current prices, and you would not buy more of it at today's price, DRIP is automatically buying more of it every quarter. Turning it off and redirecting the dividend to a better valued position is a legitimate choice, though it requires having an actually well-reasoned view rather than a reaction to recent price appreciation. The tax consideration that makes the TFSA the optimal DRIP vehicle. In a non-registered account, the dividend that triggers the DRIP purchase is taxable income in the year it is received, regardless of whether you took it as cash or reinvested it. DRIP does not defer the tax on the dividend. You receive the dividend, you owe tax on it, at the eligible dividend rate with the gross up and credit, and the DRIP then uses the gross dividend amount to purchase new shares. Each set of new shares has its own adjusted cost base, which must be tracked for eventual capital gains calculation at disposition, creating a record-keeping burden that compounds over years of DRIP purchases. In a TFSA, zero tax on the dividend, zero tax on the DRIP purchase, zero adjusted cost base tracking required, zero capital gains calculation ever. The DRIP runs on tax-free income, purchases shares at no tax cost, and generates future tax-free dividends. Every advantage of DRIP is maximized, and every friction of DRIP is eliminated simultaneously. Let's come back to where we started. 30 seconds to enable. $35,000 difference over 25 years on a $10,000 starting investment. Zero additional contributions. Zero ongoing attention. One setting. You now know exactly how DRIP creates that gap. The perpetual compounding loop of dividends, buying shares that generate more dividends that buy more shares, accelerating non-linearly over time. You know the difference between synthetic DRIP at your brokerage and corporate DRIP directly through the transfer agent, including the price discount some Canadian companies offer that most investors never access. You know the 3 situations where you should turn it off. And you know that the TFSA is the optimal DRIP vehicle specifically because it eliminates every tax friction while maximizing every compounding advantage. The only thing left is to actually log into your brokerage account and check whether DRIP is enabled on your positions. It takes 30 seconds.